Hey, everybody. Good morning. Thursday, June 25th, 2020. John, I'm glad that I could say you're waiting with nervous anticipation. I hope that's a good one, not a bad one. Hopefully, everybody's doing good. Hopefully, everybody had a great evening. Hopefully, you're ready for another little bouncy day's worth of thank you, Zach, trading here. I'm just kind of assuming that everything is going well, but always good to have the knock knock from somebody out there. I don't know where Dan. Oh, there's Daniel. He was a little late to the show, so a little bit of a bump this morning. Unemployment, the existing claims came out 1.6, a little higher than everybody was expected, but we're also seeing some other good news on the side of production numbers going a little higher than expected as well. So a little bit of a balance in the negative and the positive, kind of like that old McDLT hot side hot, cool side cool sandwich. I may have just aged myself a little too much for you. Anyhow, we're going to look at the numbers here in just a minute. Let's talk about the market open and what happened overnight. Obviously, a lot of headline news driving everything around, people trying to position themselves, and of course, the buy the dippers are trying to get in and say, hey, this is my chance to buy after the market goes down 2%. 2% doesn't make I think I said 625, correct? Yes, it's Thursday, 625, guys. Friday tomorrow, 626. We'll do freeform Friday tomorrow. I'll just throw it out there right now. Anyhow, when we look at the data that was coming out and we look at the headlines from last night, it's no reason, or it's no absolutely lack of expectation, I guess you could say, that we should see a market that's flipping around here in the morning trade. Futures tried to get a little bit positive, didn't make it. The Nasdaq composite was trying to make it, didn't make it. Let's take a look at my slides for you today. We're going to put the questions and answers. Greg, you need to wrangle everybody up a little bit and make sure we get the Q&A right in the middle today so that we don't have to rush through it at the end. Anyhow, I'm going to jump into overnight trading and today's expectations, as I always do. I'm trying to give you a picture of what happened last night, how it conveys into what we're going to see at the open, and then what to expect throughout the trading day. The troubled 33 is what I'm calling this. And I'm going to give you 3 stocks off this list to sell or hedge. So this is going to be the opportunity to pick up not only a list of 33 companies in the Nasdaq 100. Remember yesterday, I showed you the companies that were doing well, the companies that were leading. We talked about the companies above the 50-day moving average. And I said, I'm going to show you the other side of the coin. This is where we look at the other side of the coin. Companies like Cisco, Expedia, Ross stores that are trading not only below their 20-month moving average in a bear market, guys, but they're also getting ready to break through their 50-day moving average. So their intermediate term trend lines are getting ready to break. That means you've got an opportunity. So we'll talk about the troubled 33, and I just made that name up this morning. I thought it made sense. There were 33 of them, 33% of the Nasdaq's trading in, or the Nasdaq 100s in a bear market. And then, of course, we're going to hit your talk about the markets and then my trading expectations for the next 2 days. Not 1 day, but 2 days. So the morning trade this morning, overnight trading saw choppy results as futures traded higher. We're coming off the first big move lower, especially in the Nasdaq, in weeks here. The Nasdaq, even in overnight trading today, was a clear strength as buyers are trying to squeeze into this area still. This is one of those areas that is a little bit of a crowded trade. That's a lie. It's a lot of bit of a crowded trade. It's one of those that's going to get more volatile here over the next couple of weeks. It's been a great trending sector when you look at large cap tech. But when we think about this, it's one of the situations, the web is dragging in New York City or in New York. That's bad. My internet's going great here, guys. So the Nasdaq is a clear strength here as buyers are trying to squeeze into the area of the market. Watch yourself, though, because that is going to run out of fuel at some point. There's an interesting concept here. I think I may have shared this with you. Here's where we get in the weeds for just a second. And I go to the camera, of course. So I have a friend, and if I shared this with you, you're just going to have to bear through it for just a second. I have a friend that races cars at Mid-Ohio Raceway, all kinds of cars, Porsches, it doesn't matter what it is. Car's a car, right? When you get down to the basics of it, some go faster, some go slower, some are bigger, some are smaller. But one concept that he told me about rules them all. And this is where we're going to think about the Nasdaq for a second here. This is your analogy of the day. So when you're racing a car, there's a sweet spot when you're racing. Right. And when you watch the Indianapolis 500, you may hear them talk about this. They manage fuel consumption so tightly. One of the reasons is when you're running those last couple of laps on a car that's getting ready to run out of fuel, and you've probably seen it before, and the Indianapolis 500, where somebody will come around the corner on the last lap, and all of a sudden the car just drops off and starts drifting. They ran out of fuel. And you kind of sit there and go, why the hell did they run out of fuel? They've got 27 people over there in the pit that should know exactly how much fuel is. You got a guy with a computer that's got a PhD in physics that's doing this and that. The reason they run out of fuel is because the car runs faster as the fuel is getting down towards the end. It's less weight in a car, and those cars obviously are sensitive to weight. Here's your connection to the market. The market right now, as it's getting lighter in fuel, less buying power, continues to drive up even a little faster. That's why you get these quick pushes up. You get that last push higher. And then all of a sudden it runs out of gas. And the way you tell that it's running out of gas is you look at the fuel tank, which is the volume, how much volume is coming in. This is why I tell you it's so important to watch that volume on individual stocks and on the market in general. So keep that in mind here over the next couple of days. We just saw the Nasdaq pull back down. If we don't get a response with the Nasdaq shooting back higher again, on heavy volume of full fuel tank, we're running towards the finish line here on drops of fuel instead of gallons of fuel, and you've got a chance of running out of fuel right before we get to earnings season. There's your big picture for you. If you want to just take that, you can share that at your cocktail parties this weekend too, because that's a way that everybody will understand exactly what you're talking about. You have got a situation where there's less fuel in the tank, and at some point we just run out. So with that in mind, coming back to it, the clear strength of the Nasdaq, the buyers are trying to squeeze into the area of the market after the first real loss in weeks, but we want to watch that fuel gauge as we move forward. Financials and travel-related stocks, this is where they're going to get beaten up today. A couple of reasons here, and you want to focus on these two sectors right now very clearly, as well as energy. Energy seeing weakness again, the downgrade to the global outlook for the economy yesterday from the IMF, obviously causing ripples there. And I think that we're going to see, and I told you yesterday, we may see some tweaks to the actual inventory numbers that are offered, or at least the supply. I don't think it's enough to really stop what you're going to see a trending lower in oil prices again. So travel stocks are your target today, as we're seeing breaks below the 50-day trend lines in this sector. All of those all of the travel stocks have been hanging on here. You've got people coming in and buying the Robin Hood era investors, or the Dave Portnoy investors, or whoever they are, have been buying these stocks, and they've been making great money off of them. But they get to the end of the run here, and you're going to see that fickle crowd, the fickle that's there for one reason, not because they're investing in the company, but because they're investing in the price. They're going to move away from these companies. The breaks of the 50 days are going to get those accelerated. Watch companies like the Carnival Cruise Line, the Norwegian, all of these. Carnival's downgraded junk yesterday really left the markets trading down 6% this morning. So great short positions, something we may be adding now that we're breaking through some technical trend lines to the night trader positions as well. So on the other side, or other part of last night, COVID-19 is making its return. And this is something everybody expected, right? We did think that we were going to see a return. I don't think anybody expected it this quickly. I mean, some of the shops are still just trying to open up. Sip of coffee there, guys. Sorry. Some of the stores are trying to open up still. And all of a sudden, it's making this roaring comeback. We've got restaurants in Cincinnati that are already closing simply because they don't want to be affected by this again. So it's easier just to shut right back down again. It's making this return, though, amidst bullish sentiment. This is exactly what we saw in February. If you remember, we had a situation where the VIX was low in February. You had stocks rolling over. Investors were talking about new highs. They were having parties. They had their hats on. And all of a sudden, bam, COVID-19, which we didn't know it to be COVID-19 at that time. We knew it to be coronavirus, popped up its ugly head right after the Super Bowl, or right around the Super Bowl. And we all know what happened. There was a lot of optimism in the market at that point. carbon copy, except we do know that it's out there. So we're a little more nervous about it. Yesterday's headlines, though, with New York, New Jersey, Connecticut putting in new travel restrictions. You have to sit in a hotel room or somewhere for 14 days. That is bringing to another level of reality here. The sentiment has reached some relatively optimistic levels. The VIX touched down to 30. Investors' intelligence, the bull to bear ratio, went over 3. I don't know why iCloud is telling me they wanted me to do something, but there you go. So you got over 3.0. That's a bearish reading. That is actually a bearish reading when you get over 3.0 on the investors' intelligence bull to bear ratio. These readings together normally occur at or near short-term market tops. And the fact that we feel like we're running out of gas puts us in a situation where you have to be more aware. The headlines and the potential concerns over earnings added to this has to put you into a more defensive position. I'm not telling you sell everything. Clearly, you don't. There are stocks out there that continue to do well. Etsy, eBay, Zoom. There's so many of them out there. But at the same time, those the level one hedges, trailing stop losses, are the thing to have in place right now in case the market does take another 3 or 4% drop lower from here. You've got that protection in place, and then you can start to add some inverse ETFs, puts, etc. We'll talk about this during my hedging event that I'm going to be doing coming up here. Anyhow, the big question, what about earnings? What about earnings? So earnings season's coming up, obviously. Everybody's talking about it, but they're talking about it in a different way. And before I get into that, let me jump into the chart that you have to look at every day with me. 3050 was where we closed on the S&P 500 yesterday, right above that important blue line. The 20 or the 200-day moving average, there's your 50-day. We are at risk right now. This is a time to stop. I'm going to try to keep my, you know what, Kathy, come back and ask me that in a couple minutes when we hit the Q&A. I want to keep on course here so I can rip through these questions and have a nice conscious line for today for you guys. I want to make this nice and streamlined. So 3050 we closed at yesterday. Obviously, the S&P is going to give that up. We're trading down 9 points when you look at it on a real time. We popped up just a little bit here. We were down more. The Dow's down 160. So the bottom line is I think we're going to test this 200-day moving average pretty easily today. And then what's right behind it are two major tests. The 3,000 level, round numbers, guys, round numbers. 10,000 on the Nasdaq gave up. 3,000 right now on the S&P is going to be critical. So 3,000 with the 200-day, and then right below it at about, you've got 2970 or so is a 50-day. So within about 60, 70 points here on the S&P 500, you've got three major tests, 200-day, round number, 50-day. If we don't hold those, that's going to be your indication that it's time to get more aggressive on your put protection in your portfolio. And the lovely VIX pulling down to 30. I told you the night traders got out there and we initiated a leverage on the volatility on that move to the 30 level. I think we're going to actually close that out today at a 50% gain. So I'll be happy with 2 days turning into a 50% gain. But the VIX isn't done here. And the reason I'll target 50% is we can come back in when we get a pullback to 35, then play up to 45, et cetera, et cetera. It turns into a sawtooth action trade, what I call a sawtooth trade. But you get the idea here that 30 was critical. That is a level that really started to mesh up with the investors' intelligence coming up above 3.0, giving us that indication that, hey, not all is well with the market. Last time we were above 3.0 was 3.6, was in January and February. We pulled up and jumped up above that. You had December when we were at new highs and tracked back down, obviously, went below 1. This is a bullish reading when you go below 1 on investors' intelligence. Usually anything that starts with the dot or 0 dot something is bullish, bullish, bullish. You can see what we did in 08, 09. But the fact that we rebounded so quickly, look at the action in 08, 09. We shot straight back up. This tells you that irrationality trade was in place and has taken us to a frothy market. Frothy market is what we're going to call it. Now we're not. A bubbly market, because I don't like the fact that frothy's term is used so often in the media. So On to earnings. Earnings season is going to kick off in 2 weeks. The financials make their way to the earnings confessional. So the media and the analyst, I've been reading and listening to it. They're giving the companies a yard pass. They're saying the same thing that you and I were talking about last earnings season. It's a kitchen sink quarter. You can tell them that you messed up and used corporate funds to buy a Ferrari, and that caused earnings to dip a little bit. And I think the market's going to give up and say, hey, it may be egregious, but you know what? COVID-19, that's fine. Let's move on. I joke about the Ferrari, but you get the idea. You can come out and say, hey, we lost money, we made money, et cetera, et cetera. You had KB Homes, made money on the top line because they killed it on their margins, but revenue, they missed by 10% yesterday. So you're going to have all kinds of these mixed, and the big phrase is going to be, we're not issuing guidance for our fiscal year 2021. And that's where you get the yard pass. But there's a catch here. Stress test results are being released this afternoon at 4:30 for the banks. Fed finished those up. Everybody's homework's done. They're coming back. They get their grade. It's kind of like the teacher walking through the class, putting the grade on everybody's desk at the end of the day. This is going to be a little more of a setup for earnings, because what happened during that stress test, and these stress tests had an extra little kicker, and I think it's great. It was the COVID-19. This was going on during COVID-19's pandemic, out when we were crescendoing with the pandemic. So there was a real life stress test going on with these financials. I think that's great for somebody that's on the other side of the counter, on the other side of the stock. I think it's great that these companies and the Fed actually did consider that as part of the stress test, but they're being released today, 4:30. The catch is the companies are now going to form their response to the stress test over the next couple of weeks. And you're going to see them announce that during their earnings season. So earnings season is more than just earnings season this quarter. Everybody's worried about dividends getting cut in the financials and what they're going to do. That's when you're going to see it, the unexpected risk with the financials right now. Dividends and other changes to the bank's cash flow are going to be part of that upcoming earnings report. This is where the danger lies, not in the, oh, we made money or lost money over the last quarter. All you have to do is say COVID-19. So you can't necessarily do the same thing with the stress test because it was designated years ago and they make tweaks to it, but it is what it is. So I want you to watch when we talk about hedges. We talked about in April about hedging the financials using the SKF or using October options or December options on the XLF. Remember, the XLF has been actually, if you look at it, not keeping up with the rest of the market and has been turning sideways here as we start to see the market weaken. So when you look at the XLF and here's your chart, you're sitting on your 50-day already, and you're getting ready to break through that $23 level. We're already making a path to and well off the 200-day that everybody else is just coming off of. You're already seeing that weakness in the financials. So be aware that as we head into that earnings season, not only is there a dangerous fundamental risk, but there's also a dangerous risk to the financials here that goes beyond what we're going to see in earnings. So let's look at the outside of technology and the troubled 33. 33% of the Nasdaq 100 index are now trading in bear market trends. They're trading below their 20-month moving averages. Many of the names are the same that were in this position at the beginning of the year. Frankly, people, this is one of the reasons that in January, February, we were loading up on puts, and we had a great March and April because of it. The growing number of companies that were trading below their 20-month moving average, Cisco being one of the telltale companies, caused me to look at this and say, okay, this is a growing problem here. Those long-term trend lines tend to affect the larger money, the professionally managed money, the hedge fund, and the mutual fund managers are going to start pulling assets out. That number has now gone up from 18% then. Now we're at 33%. So there's a risk here just because of the number that is in that actual 20-month trading below the 20-month moving average group. Many of the names of this are the same. The long-term trends are compounded now in real time by new breaks below the 50-day moving averages. We've seen a lot of these stocks bounce back up, but still remain in a bear market. This tells you that this list of companies, And I'll share some from the S&P 500 with you tomorrow, just a couple tomorrow. But these companies in the tech-heavy Nasdaq sector are the ones that haven't been getting any love and are about to get rejected even further. There's your list. American Airlines, shocker. Sirius, not so much of a shocker. Cisco, Comcast, Starbucks in a bear market. Wynn Resorts, not a shocker. Expedia, kind of a little bit. Mylan, Marriott, Walgreen Boots, Western Digital, Fiserv. These are companies that a lot of people, if you asked, where is Baidu? Is Baidu in a bull or a bear market? Oh my gosh, Baidu's in a bull market. You should be buying it right now. Baidu's in a bear market right now. Dollar Tree still in a bear market. You don't hear me talking about Dollar Tree when we talk about TJ Maxx and Ollie's because Dollar Tree's not been able to get it into the groove here. Henry Schein, I mean, the list goes on and on. Ulta. The bottom line is this is one of those lists of stocks that are telling you we're in a little bit of a trouble here, or we're in a bit of trouble already, and we're getting ready to face a headwind, a short-term headwind that's going to cause us to get into more trouble. So some of these are expected, as I said. Wynn, Marriott, come on. They've got rooms all over the place that aren't being booked, and it's going to get worse now. But a few of them that I want you to focus on today, over the next couple of days, I'm going to give you 3. And maybe Greg and I can figure out a way to get the troubled 33 up on in a commentary or something, because I know you'd probably like to see the whole list. Western Digital, breaking through its 50-day moving average yesterday. You can see the consolidation that we've seen. It's been fighting to stay above that 50-day moving average, and it's been stuck in a range here. But the 50 days rolling over along with the 20-day, and it's trading below its 20-month, and the 200 days trending lower. Western Digital, in my opinion, is heading back down to $32, $33 here over the next probably couple of maybe month or so. Sure, a decent earnings announcement might help the stock get a couple days worth of bump, but the long-term trend is so friendly right now for this stock, and the short-term trend is turning unfriendly, that it's just too much of insurmountable. And for those trading, it's got a lot of room to move until it gets into an oversold reading. So I love the way that you can do you can actually squeeze out a nice short-term trade on this company right now. Another one, CSX. Transportation stocks were turning up because we were shipping stuff across the country to stores, trying to get the economy reopened now. And you can see CSX took off from $48 to $78. Great performance here. Still trading below its 20-month moving average and just slipped below its 200. The 20 days rolled over. 50 days still trending higher. Trend is still friendly for the traders here. My problem is this break is going to bring in a whole new group of sellers. And you can see the volume. The gas tank has been low here, except when we actually moved down and touched the 50-day here last week. So right now with CSX, a break below that is going to take out that 66 level, and we're going to see something that'll run down another 10 to 20%, maybe down to the $56, $57 level. So CSX right now, one of those on the bearish list, and I think that it's going to lead us down as well. And in transportation stocks are slowing down. Cisco, finally. December, I wrote about how Cisco, I got on the TD Ameritrade network and talked with Nicole about how Cisco was in a bear market and nobody was talking about it. And it was interesting to her. It's interesting to me at this point. You're seeing a situation just a lot like what we had then. You had resistance overhead with the 200-day moving average. Now you're breaking down below it. The 50-day was doing a little bit of a dance trying to save itself. Same thing here. 20 days rolled over, 20-day rolled over. Does Cisco go back to 33 from 45 right now? I think it takes a stop at 40 and a little bit of a rest. And Cisco is well known for stopping at round numbers, 40, 50, 30, 20, etc. Take a look at Cisco right now. The break below 44 and the 50-day moving average generates a return or a move that's going to take us down to the 40 pretty quickly. Obviously, Greg, we're getting some questions here about this. We'll put together something that I'd love. And if you want, I'll back it up here for a second so you can get a screenshot of the troubled 33. I'll leave it up here for just a couple seconds, and everybody can try to just hit the print screen. button on your keyboard, and you should be able to. It should take a snapshot of that for you. But that is your trouble 33. I also have been putting it into form that I can look at it by sector, so you can identify which sectors are seeing maybe those more of a downward bias because they're in that long-term bear market, or you've got a higher number of stocks. I can tell you, obviously, travel-related stocks, some of the gambling stocks, Win, etc. They have a larger number. So let's move on to your questions. Let's get them out. We've got about 5-10 minutes here to run through those. Let's talk about your questions and your tickers. I don't know if we've got them in the Q&A. I'm going to bounce over there, and we've got 7 right now. I'm going to go with what's in the question and answer because you guys have taken the time to put the questions in there. Are we still buying the dip on oil stocks? No. Buying the dip on oil stocks is kind of a little bit, and let's pull up the chart as I start to talk about this. You don't want to really jump into let's look at XES for an example. XES, not XEW. Let's look at XES, which is the oil equipment and services, coming down on the 50-day moving average right now. Lots of pressure. This report from the IMF yesterday on 4.9% contraction in the worldwide economies really kind of puts a crimp on the idea that there's going to be a lot of demand out there for energy. I think right now you look at the energy sector and the related companies, whether it's looking at some of the oil companies like ExxonMobil, they're going to be safe companies in this group. And then they're going to be the companies that are, I heard the term zombie companies, and I think that's a great one, where they're just trying to pay their dividend and they're trying to make their salary so they can continue operating as long as possible before they go bankrupt or get purchased. ExxonMobil, obviously not one of those, but breaking down below its 50-day, I think that's a great indication or a great canary in the coal mine for the rest of the group. Let this group go down. Oil is going back down. We talked about oil going down around 7 to 10%. We got it. It started to bounce up again, and we're failing again. I think you see a company like ExxonMobil going down another 10 to 15%, which will put it down around that 40 level before it turns into some sort of pickup, a buy the dip, if you will. Oil is going back down. What about the airlines? You've got Love. Love is actually, let's look at Love, and the airlines are getting beat up again today. So nobody really saw the COVID-19 coming back this quickly. 50 days going to be in play on Love. You're nearing an oversold reading, probably actually a week or so away from it, I'd say, at the current rate. But we're going to slice through the 50-day today. These travel and travel related, I think we need to put them back into an isolation booth here, let things cool off. Carnival Cruise Line and a few other those I'm looking at as short-term trade opportunities. You see the 50-day in play on Carnival, and it's going to slash through that today. I think you put the travel stocks on the side. Love, I'd have a trailing stop on it, but it's going to trigger right away. COVID picking up. Is housing and mortgage business going to reverse this summer? Gary, I don't think we're going to see an immediate reversal in the housing and the mortgage business. I think that you've got probably a couple of months left in this. You have active buyers out there that are looking, people trying to move from urban areas, people trying to downsize, people trying to do all kinds of things. And an interesting thing that somebody brought up to me yesterday was, we're going to have a baby boom in 8 months or so. And people are going to be looking to upgrade their houses for more space. I giggle a little bit when I say that, but it's absolutely true. So I think you still see the housing market continue to pace its way through the summer months. My neighbor across the street, I may have mentioned this. Yes, actually I didn't, because it was after our live stream call yesterday. My neighbor put their house up on the market last week. The first day, the first hour, they had 5 offers and they got 20% more than their asking price. That's $600,000 house. It's not a small amount. So I think what you're going to see is this market continue, because of the constrained inventory, to make its way higher. The builders, I think you want to watch a little bit, because they're obviously going to peak a little bit early here, because they got to gear up and put money into their portfolios. UCO, SLB, Oxy, Halliburton, time to sell. Let's go ahead and say blanket, Jeff. Yes, at minimum, you should have a trailing stop on those. Those have been hedged areas, or should be hedged areas of the market. With everything breaking through its 50-day moving average, I think you get a time to buy them back. If you have profits on them, especially anybody that's where you should be doing your profit trimming. When you own these sectors that are breaking down below their 50-day, it's time to take some profits and buy them back lower. Another 1.5 million filed for unemployment last week. Yep, the number was higher. The expectation was 1.3, depending on what you were looking at it. The unemployment picture is getting a little bit muddled right now. And we're going to get, remember, markets close next Friday, so we get the jobs report next Thursday instead of Friday. That's going to be the biggie, because we've seen unemployment numbers and we've seen state numbers that have been improving. All of a sudden, if we don't get a nice surprise like we did last month on the employment number, you're going to see a market that's going to turn into a bit of a tailspin here. And you also have earnings coming up a week or so after that. So I think you'll have people on guard. Naveed's got the 65 call on Lennar. Can I add the calls as the market's going up or getting out? Naveed, I can't give you individual advice and say, this is what I would be doing. I can't give you a directive like that. I can tell you that Lennar, and if we look at the chart of Lennar, it's seen some challenges after they announced their earnings last week. The stock's pulled back right now. The 200 days right below you, 57.5 as well, consolidation point. This looks like a spot where you're going to see Lennar kind of consolidate. The additional weakness of the market's going to add some pressure to it. Over a next, your July 17 date is the thing that is a stumbling point. Do you have 3 weeks for this to play out? That's the big question that I'd have to ask. It could be a situation where, an options trader might want to roll that out to another expiration, the August 21s, or one of the weeklies that are traded on it. That would be obviously something that you would have to decide. Hope that helps. Barbara, what's a good infrastructure play, assuming there's a bill? Anything concrete you want to? U.S. Concrete would be one. Also, you know what? There's Trinity, and they deal with I always look at Trinity. TRN is the ticker symbol. And you can see they got a little bit of a boost when that was announced right in here. The stock's been doing well because we're assuming that we're going to see, and this is a seasonal play as well, Barbara. You get into the summer, and Trinity, they're the people that make the guardrails for the highway. So if there's any building going on, that's a company that's benefiting from it. Watch it here with the 200-day and the 50-day, but you also, U.S. Concrete's another one you want to look at. Any type of aggregates will play out pretty well as well. What do you would you do a Groupon put spread for 7/24 for July 24? Let's look at Groupon and just kind of give you a bull or bear what it looks like. Groupon's been a choppy trade all over the place, simply because of what they've had in terms of their business. Groupon was on the right side of the business, wrong side. Groupon's always been one of those that I've tried to stay away from trading, quite frankly. $19, $20 here is a little bit of the support. You can see it, boom. Not so much there, but definitely we're seeing it right along. I think right now with the trend on the 20-day turning and the 50-day leveling out, you've got volume that's been dropping off after we saw the spike here. And you got the reverse, you got the stock split that occurred here, and stock split obviously doesn't do anything for a change in the value or the valuation of the company. Watch $20 right now. I think a break on 20 takes you to 16 pretty quickly. So that's a 20% drop right there. That's how you figure out what you'd like to do with the put spread. And obviously pretty cheap stock anyway. EGHT still a hold? Guy, yes. It's still a hold. Linda, yes, it's still a hold. EGHT gave us a pull yesterday or pullback yesterday and started its trek lower. I am looking for the stock, and it's up a little bit in pre-market, but 14.93, we got back below that 15 level. Let's pull up that chart of EGHT. Got back below that $15 level, which is exactly what I was hoping was going to happen. The 20-day as well. We might get a little bit of a bump just because of that 20-day and the $15 level. But from there, it should be a break straight down to 14, and we should gain some momentum to the downside. August option was looking for it to play a little bit longer term. 4.6 million delinquent mortgage payments. Will that kill bank stocks 9 months from now? Another interesting thing on zombie, using zombie terms, is the indication that we're going to have that stimulus package. It continues to go, Zachary. Sorry, guys. We're going to continue to see the stimulus package, and the banks have actually seen fewer delinquent mortgage payments and forbearances because people that have been laid off have had extra cash put in their pocket and they're paying their bills instead of just spending it on something else. So I think that you will see a wave of those delinquent mortgages. I think that if the big key here is the fiscal stimulus, if the fiscal stimulus slows down, then you're going to have problems with the bank servicing those mortgages and delinquencies. But I think you'll see an increase in the forbearances. The forbearances did not get taken advantage of as much as the banks thought that they would, the forbearances that they offered in April. That's going to be the first line. And of course, that doesn't affect it because you're just putting your payment on the end of your mortgage. So it just adds up to a little more interest for the bank. I don't think it's going to get killed. GSX. So we pull up the GSX Tech, and I'm reading the chart. Overbought, 55 resistance. Love the 50-day turning higher. This stock comes back to 45 bucks and turns into a limit order buy in my book if I'm trading the stock. You've got the volume dropping off very quickly on it. Let me look at the monthly. The monthly chart's going to be good on this as well. It's going to be short, but yeah, I mean, this is. Call it a phenom stock, call it whatever you like. I usually call them phenom. That's a phenom chart. But at the same time, you've got such a nice ramp here. You've got great volume that came through. Overbought became more overbought. This is clearly you don't call it a crowded trade, but this is picking up, the bus is picking up people consistently. More traders getting into this is indicated by the higher volume. Watch that resistance at 57.5 with the overbought, rolls over and comes down to maybe the 47.5. It looks like it starts to get picked up there. And then 45 is where you really draw a line and it turns into a much better buy. I do still like Neophotonics, NPTN, pulled back down yesterday. I am actually looking at this. Personal disclosure out of the way here. I've owned this stock. I continue to buy and sell this stock. I trade this stock often. $8 is the level I look at and say when it hits 8, I'd like to have a limit. I have a limit order in to buy it at 8, and then it'll turn around and make a run up to 9. I do not like the fact that the 20 days starting to roll over and the 50 days leveling out. That's what we get for it pulling back like this. The 200-day is still at 775 though, and the volume's been rather consistent. You can see here, we're going to get an oversold reading when we pull back to 8 as well. Like it. It's a good play on the on semiconductors, less known, and also a little bit of a 5G kind of connection there. Clicking back over to the chat here for about 2 minutes worth of extras. Holy mo! Oh, Greg is sending the list. I thought we were looking at all those charts. Let's look at Slack. Slack got hit hard yesterday. Slack pulled back about 6%. The company came out, announced that they're going to have a multi-stream version of Slack where you can use multiple companies right now. This is kind of what I was looking for, not as much as I'd hoped, to be honest. The company is trying to get into more of an enterprise position where they can compete with not Google, but Microsoft Teams. The CEO was on yesterday after the close on CNBC, and I thought it was interesting that he talked about how they're not in competition with Microsoft because they're different products. I don't believe that to be true. When you look at Zoom, I think it would be awesome if you saw Slack and Zoom get together and start to put a product together. You definitely snag a nice piece of the market share if you could do something like that. I don't know if it could be done, but if you started to integrate more tools into Slack, I think it would be better. I'm getting into the weeds though. Their new product is going to be across different companies. You can pull in different companies and have multiple channels that are separated, but also can talk to each other. It's moving the needle a little bit in product. Stock's up 1% right now in the pre-market when everybody else is down. I think that we get into a situation where work is actually going to start trending higher again. We got a nice little bump during this week until it pulled back yesterday. There's your chart on it. Dean, as for whether or not to get in or not, the 50-day is still trending higher on it. Yesterday probably is where you got stopped out because we got this nice little bump above the 200-day. I want to see it move back up above that 34 level. I mean, we're right back where we started with the position when we opened it back on the 5th of June on the earnings pullback. Get the support at 32 and then get it back above 34. I think the stock still runs to 36, 38 or so. For some reason, you heard unloved, but it's actually troubled. Yes, it is troubled. Oil is going down for a while. What about the airlines? Yep. Jesus, I think the airlines, let's look at Delta because it's not the most offensive when you look at the airlines right now. Obviously, United is one of those that you put, or American also. And American was number one on the list of the troubled 33 as well. Look at Delta Airlines, though, coming back down to that 50-day moving average. Buying the rumor here, selling the news. But the problem is the news is only hitting right in here right now. And remember, Delta's got just let's call it pending layoffs coming or pending firings coming in October. As soon as they clear the hurdle for the PPP, they've made it clear that they are going to cut their staff. They're going to cut pilots. They're going to cut flight attendants. It's good for the stock in terms of restructuring a little bit, but at the same time, you got to get through the pain of getting there. I think it breaks through the 50-day here. Let's look at United Airlines as well and other travel. And I've got to take one of the things I said off of the table. UAL's in the same situation. AAL, American Airlines Group, same situation, a little more exaggerated. I got to take something off the table, folks. And this is one of those things where yes, Macy's did lay off. So this morning they announced that. This is one of those situations where when you get more information, you change your view or you adapt your view. Expedia, TripAdvisor, those companies that I said are going to be the better play right now on the travel agents or the travel side outside of the airlines and the cruise ships. I still subscribe to that in terms of they offer you more diversification. Carnival Cruise Lines, you're just dealing with a downgraded junk status. You don't have to deal with that with Expedia. As a matter of fact, Expedia has people coming in to invest with them. But with the travel industry slowing down, you're seeing what's happening in Las Vegas, New York, New Jersey, Connecticut, Florida, Texas, Arizona. You get the idea. These companies are going to contract just as much. I think it's going to be less than you'll see with the airline companies. And that can be key. If you look at Expedia, EXPE, don't think it's a buy right now. The trend has turned against it. We're seeing a rotation out of the stock, and it's following something close to what we're seeing with the airlines, a little less of an exaggerated move, though. So I think that's where you start to, look at the opportunity, not necessarily in the area of the airlines and not necessarily in Expedia. Let's face it, we're either shorting these companies now or we're hanging in and just hedging them or hanging in and not buying them. But I think it's going to be more of a situation where you're going to be shorting. All right, folks, that is going to be it. I'll see my night trading people here in an hour and a half. As always, I wish you the best trading success and look forward to seeing you tomorrow. We will do a little bit more of a free flow Friday. I'll get my slides out of the way early. All right. Hope everybody has a great day trading, and we'll see you soon. Bye-bye.